Most traders think more action means more profit. So they scalp every move, every tick, every candle. But professionals don't trade noise. They manage risk. It's not about trading more. It's about hedging when it actually matters. Today, you'll learn why overscalping destroys gamma profits and how disciplined hedging actually makes money. If you want to understand how professionals actually manage risk, make sure you're subscribed.
All right, let's talk about one of the most butchered concepts in all of options trading, gamma scalping. We're going to cut through the noise and figure out how to hedge smarter, not just more. So let's get right to it. Here's the big question. Why does that constant rapid-fire scalping, the kind that feels like you're doing something right, so often end up absolutely destroying your gamma profits? It's a huge trap, and we're going to show you exactly how to sidestep it. You know, the whole problem really starts with this one simple misunderstanding. A ton of traders think that gamma scalping is just aggressive day trading, jumping in and out, buying and selling futures constantly to scalp every little penny. But that's not just wrong, it completely misses the whole point of the strategy. Okay, so to really get this right, we need to draw a very clear line in the sand. We have to separate the professional's approach, which is hedging, from the retail mistake, which is just trading noise. On the surface, they might look kind of similar, but trust me, their goals and, more importantly, their results are worlds apart. So what are we actually trying to accomplish? Well, it's called Delta Hedging, and it's a controlled, very selective process. The idea is you get your position delta neutral, and then you make these really deliberate adjustments just to stay neutral as the market moves around. Your goal isn't to guess which way the market's going. No, it's to make money from the volatility itself. You're harvesting the option's convexity. Now, compare that to scalping noise. This is what happens when you treat every single uptick and downtick like it's some kind of urgent signal to act. It's pure reaction. Price ticks up, you sell. Price ticks down, you buy. You're not actually managing a position at this point. You're just chasing completely random, meaningless little blips on the screen. And this really breaks it down perfectly. You've got two paths. On one side, you have this controlled, selective strategy that's all about managing your risk and harvesting that beautiful convexity. And on the other side, you've got this reactive, random mess that just chases price ticks and ends up creating a mountain of completely unnecessary costs. This is so important, you really need to let it sink in. Not every single price movement deserves a hedge. In fact, most of them are just noise. The real power in this strategy comes from being selective, not from being frantic. All right, so let's dig into the cold, hard numbers. Why is this mistake so incredibly destructive to your account? Well, there are three big profit killers that get activated when you overtrade, and they will systematically bleed you dry. First up, the obvious one, transaction costs. Every single trade costs you something, whether it's commissions or the bid-ask spread. Number two is slippage. That's the difference between the price you think you're going to get and the price you actually get. It's like a hidden tax, especially in fast markets. And finally, the big one, Theta. Man, this thing is a relentless force. Your option is losing value every single second because of time decay, and all that frantic trading does absolutely nothing to stop it. I want you to think about it like this. Every one of those tiny, useless hedges you make is like pulling a single dollar bill out of a big stack of cash. You do it once, maybe twice, you probably won't even notice. But if you do it over and over and over again, reacting to every little bit of market noise, you are literally guaranteeing that by the end, there will be nothing left. And that brings us to the fundamental battle you're in. Gamma only pays you when the market makes a real, meaningful move. But Theta is charging you rent every single second. So your profits from Gamma have to be big enough to overcome that constant ticking clock of time decay. So if we're not supposed to react to every little price tick, what are we supposed to be looking at? Well, the answer is right there in the name of the strategy. It's Gamma. Gamma is what dictates the hedge. That is the one variable that should be driving all of your decisions. So what even is Gamma? Put simply, it tells you how fast your delta is changing. So if you think of delta as the speed of your position's exposure to price, then Gamma is its acceleration. It's telling you just how quickly your directional risk is about to ramp up or down when the market starts to move. And this relationship is absolutely critical to understand. When you have high gamma, your delta is going to swing around like crazy with even small price moves. It makes your position super sensitive. But when you have low gamma, your delta changes much more slowly. Your position is just way more stable. And here it is. This is the big aha moment of this whole thing. Your decision to hedge, how often you act, should be driven by how big your gamma is, not by the random chatter of the market. High gamma means you need to pay more attention and, yeah, maybe make more frequent adjustments. Low gamma means you can and should sit on your hands more. So all of this leads us to the correct mental model. See, it's not about being the fastest gunslinger in the market. It's about being the smartest, most disciplined hedger. Let's really contrast the wrong way with the right way. So you've got two paths you can go down. On the left is micro scalping. It's emotional, it's driven by gut feelings, it's incredibly cost heavy, and while it feels like you're being active, you're actually just grinding your own edge away. But on the right, you've got what we call structure scalping. Here, you only hedge after a meaningful move. Your decisions are based on the actual structure of your options, and this discipline is what preserves your edge and actually lets you be profitable. Let that one really sink in. This is not a race. The market does not hand out trophies for the highest number of trades. It rewards people who act with discipline and with purpose, not just for the sake of feeling busy. So why does this less is more approach actually win in the long run? It's simple. Your real edge comes from the size of the price move, not how many times you click the mouse. By waiting for those bigger, more significant moves, you capture the real benefit of gamma, and you dramatically cut down on that profit erosion from costs and slippage. You have to remember, activity does not equal profitability. And that right there is the ultimate takeaway. Gamma scalping is not a trading tactic. It is a risk management strategy. It's all about hedging smarter, not just trading more. So I'm going to leave you with this question. I want you to go look at your own trading. Are your actions being driven by the actual structure of your position, by your gamma? Or are you just getting caught up, reacting to every little tick on the chart? Are you hedging with discipline, or are you just trading noise?